It's November of 1996. The S&P 500 is trading at 750 points. Optimism is high. In the following years, market continued to flourish, reaching 1500 points by July 2000. Then came the dot-com bubble, and the other global events dragged the index back to under 800 points by October of 2002. For many, it seemed that the stock market was indeed a risky gamble all along. But then the market recovered, reaching 1560 points by October 2007. Once again, the global financial crisis rocked the global markets. Many Wall Street giants struggled, some survived only with bailouts. By March 2009, the market had dropped to around 680 points once again. These cycles of high and lows have tested investors' confidence repeatedly. Yet the S&P 500 has continued to grow, overcoming obstacles like COVID-19 to reach nearly 6,000 points in November 2024. That's over 700% growth since 1996, averaging 7.7% annually. Or for those who began investing just after the 2009 crash, a CAGR of 15.6%. Trading stocks is now easier than ever thanks to the advent of online platforms. When I started trading long time ago, only few brokers offered platforms for live trading. What seems so simple today was a range of complications. Thankfully, we have a number of platforms available today. A quick online search will return a list of trading platforms available in your region. But it's quite challenging to pick one. Almost all of them will claim to be the best. In this video, I will cover the key factors to consider when you're choosing a platform and getting started with trading. Allow me to give you a quick walkthrough of a couple of such platforms. These are not paid placements, but just the apps that I have used for myself. Most of the apps that you'll find out there are built around somewhat similar architecture. However, what they offer may be different from one to another, which we will also explore slightly later in the video. The first one we will explore is called EToro. I have been using this app for some time. I personally like the overall interface and the ease of use. It allows to maintain a number of watch lists. There is a search or explore option, but one of the key features that can be quite helpful is for beginners is called copy trader. Again, this is somewhat unique in a way that while some of the apps have similar offering, it's not commonly found across the industry. I feel this can be quite helpful, especially for beginners. Here the user can research for popular traders and research their past performance and study their current holdings. In case the user chooses to copy their trades, your account will automatically start copying their each and every move and maintaining the portfolio in proportion of your investment with a stop loss feature that's built in. Additionally, this app also allows opening contracts for short selling and also has an offering for margin trading. Do remember that such instruments usually come with incremental fees. I also like their built-in technical interface, which offers most of the technical indicators that you may use. Let's quickly explore another app. This one is called Trading 212. I like it for its simplicity, although it has limited features as compared to eToro, but I like the ease of using around-the-clock trading, which allows the access to off-market prices. The other key feature that I like is the interest on uninvested funds and the ability to stock transfer in and out of the platform. Similar to eToro's copy trader, Trading 212 has the feature of investing in pies, which are created by other users on the platform. However, I think it's not as advanced as the copy trader feature of eToro. Nonetheless, it provides insight into the portfolios that the other users are creating for themselves, with the ability to have social interaction via communities. Now let's explore what are the key things that we should look at when choosing a trading platform for ourselves. One of the first decisions is whether to go with a traditional bank or an online trading platform. Many established banks have in-house divisions to manage investments. However, many of them are beginning to spin off these operations due to highly competitive rates and services being offered by upcoming platforms. Most of these platforms like Robinhood, Webull, and eToro are designed specifically for modern, self-directed investors and often come with lower fees and no minimum balance requirements. They also tend to offer more user-friendly, intuitive interfaces with access to tools like charting softwares, real-time data, and social trading features. Ultimately, the choice between a banking platform and an online one depends on your personal preference and priorities. Whether you value the support and security of an established bank or the flexibility and low cost that online platforms typically provide. While the bank of course appears to be more reliable, believe me, in most markets the online platforms are just as regulated and offer somewhat similar level of security. One last thing before we move on. It may be a good idea to check where will the shares be held and is it in line with what is the best offer in your region. For instance, in Australia, Australian shares can be held in what is called CHESS sponsored account. That ensures that shares will always remain safe even if the platform goes bust. Do you know what kind of instruments you want to deal in? For most beginners, it will be mostly stocks and most platforms will serve this purpose. But once you advance in your journey, you may intend to diversify in other instruments like margin trading contracts, calls, or puts. Well, not all platforms offer all of these options. Something to consider as you make your selection. Transaction fee is perhaps the most critical factor for many, especially if you plan on making frequent trades or invest in fractional trades. Offering free trades has been a key enabler that has attracted common small-scale investors. This has disrupted the entire dynamics of stock exchange. Imagine if you have to pay $20 per transaction, will it ever make sense to buy a single unit of $10 share? However, these fees can vary between platforms and over time can have a significant impact on your return. Some platforms charge a flat fee transaction, which may be manageable for larger trades, but can quickly add up if you're trading small amounts of frequently buying and selling. It's important to be aware of some usual methods of hidden cost on these platforms. These include inactivity fees, withdrawal fees, or charges for currency conversions if you are trading international stocks. Taking the time to understand these fees upfront will help you make a more informed decision and prevent unexpected expenses later on. Lately, offering bonus shares or other incentives at sign up and friend invitations has become quite common. For example, some platforms may give you a free share of a well-known stock just for opening an account or making your first deposit. These bonus shares can be a great way to start building your portfolio without any initial out-of-pocket costs. Therefore, you may consider using an invitation link from your friend who are already on your shortlisted platform, as it can be mutually beneficial to both of you. It's important to know that transactions are almost always settled in primary currency of the exchange. Therefore, when you make a trade in US exchanges, the transaction will be settled in US dollar. Similarly, you will need to settle in euro for European stocks. If you plan to trade international stocks or hold a diverse portfolio across multiple markets, choosing a platform that allows you to select or hold multiple primary currencies can help you avoid these conversion fees. For instance, platforms like Interactive Brokers or Trading 212 let you hold balances in several different currencies, which means you can keep funds in euros, pounds, or other currencies without converting every time you trade. This flexibility can be especially beneficial for investors regularly trading foreign stocks. So by choosing a platform that supports multiple primary currencies or provide lower conversion fee, you can save more and avoid unnecessary costs that can chip away at your investment growth over time. Similarly, as this money is held in these platforms, it's important to also note, will this platform offer you interest while this money is sitting there uninvested? This will ensure that your capital is always at work. Here is an example of what Trading 212 offers as an interest for its primary currencies. Fractional share is a really important feature for me. In fact, if a platform does not offer fractional shares, then it is an automatic deal breaker for me. It's not because I want to necessarily trade in fractional shares, but more so because it indicates that the platform is not oriented to small scale investors and therefore the features will be very limited. Just like fractional shares, minimum trade size is just as an important feature to consider for people working with small budgets. While some platforms set a minimum investment for each trade, others allow you to invest as little as $1 per trade. Another element which I always consider is that how the platform handles transfer of funds, as this can vary widely from one to another. Some platforms will only allow traditional bank transfers, while others are more flexible to even allow credit cards or PayPal, etc. It's also worth considering whether the platform allows for easy withdrawals through the same method. However, each transfer option may come with different fees, processing times, and even withdrawal limits. So it's crucial to understand these details upfront. Also, does the platform allow you to move your own shares portfolio in and out of the platform? This can be really helpful if you are keen in building a long-term portfolio and continuously averaging your price. Now imagine if you have to lose all your shares that you produced at a really good price just because you want to move to another platform. In addition to these essential features, there are a few other features that you may also want to consider. For example, paper trading. Many trading platforms now offer what is called a paper trading feature, also known as a demo or virtual account, which allows you to practice trading with simulated funds instead of real money. This feature can be invaluable for beginners as it lets you experience real market conditions without any financial risk. With a paper money account, you can buy and sell stocks, try out different investment strategies, do backtesting, and learn how various orders work, all in a live trading environment without putting your actual funds at risk. The advantage here is that you can make mistakes and learn from them without losing your money. Interfaces can be just as crucial when choosing a trading platform. For beginners, a user-friendly, simple interface can make a world of a difference. How the platform handles dividends, especially for the fractional shares, is also important. Personally, I like the dividend reinvestment feature as it takes away the additional manual activity and reduces the chance of missing out on this. Similarly, ease of investing is especially important for beginners. Some platforms allow the investor to follow trades of other more seasoned investors on the platform. For instance, EToro has what is called a copy trader feature, whereas Trading 212 has a somewhat similar feature that allows you to invest in portfolios termed as pies, created and copied by others. There are a few other items that you may consider, but then the list never ends. In the end, remember that there is nothing wrong in making mistake with your first choice of platform. As long as it allows you to transfer out your portfolio, you can always move to a better platform once you have enough experience in this.